Listening to family and friends who are not investors and know nothing about real estate other than they bought one property themselves. Don't listen to them. You need to build your own professional team around you. The bank will lend you too much money. Bank or a mortgage broker, they make money by selling you money. They don't care about what you're investing in. They'll lend you too much. So you need to take a risk assessment of where you are. Think about how much tax you're paying right now, how much you work. You're probably needing the 30% tax bracket or maybe the 47. That's 30% of your life that's going to the government. Welcome to the Passive Property Investor Podcast, where I teach you how to stop trading your time for money with property investment. I'm Jerry Parker, your property investment consultant. Let's dive in. Hello, property investors. Welcome back to yet another episode of the Passive Property Investor Podcast. Today, we're going to talk about the 10 biggest mistakes property investors make. Classic. Mistake number one, not investing. If you don't invest, you won't get ahead. You won't work your way to freedom. And if you're having a tough time getting there, let me help you think about some things that you should be thinking about. Think about how much tax you're paying right now and how much you work. And you're probably needing the 30% tax bracket or maybe the 47. That's 30% of your life that's going to the government. 30% of the time, because you're trading your time for money. That's what you're doing. If you invest, that can go away. And here's another thing you can think about as well. It's the lazy equity that's in your house. Think about the lazy equity you have when you get in your car and you're driving to work in the traffic every single day, and that equity is sitting there on the sofa back at home watching TV while you're going to work. Just think about those things. Those are two big problems that investing solve. So keep thinking about those. Okay, number two is not having a financial goal before you're going into making a property investment. People, they approach the market, maybe they go into the wolf's den of realestate.com and talk to a real estate agent, and they're driven by how much they're going to invest by the whatever they're for sale for, and not understanding how much you're going to invest and building a financial model of the way this property is going to go up in value and the cash flows that will come through on a financial goal is a big mistake in how people get lost in the negotiation game, and they get confused and they don't have a number to attach themselves to, and then they make a big mistake. Number three, and it kind of leads to this. Number three is probably the most classic, is a borrow too much. You have to go through, okay, you've got your borrowing capacity that a money salesperson will happily tell you. A money salesperson is a bank or a mortgage broker. They make money by selling you money. And they don't care about what you're investing in, and they'll lend you too much. The bank will lend you too much money. And so you need to take a risk assessment of where you are, of how much risk can you take, and never borrow to their maximum borrowing capacity. Always have a risk buffer. It can be 5%, 6%, 10%, 20%. You always have to have a risk buffer. Number four, wrong location. Classic mistake. You need to do location research and find areas that are going to go up in value, that you know exactly why they're going to go up in value. If there's a new highway coming through and there's a new train station, well, the train station is going to make the properties go up in value, right? So if you get close to the train station, your property will go up in value. So why are you buying that location? Because the train station is there. There's a specific reason every time. We don't want to go into a rising tide lifts all boats. And that's what a lot of the salespeople are telling you. Oh, it's going up. It's going up. But why? Why is this area going up? Tell me why exactly. You want to be able to point to that train station, point to that hospital, and that's what you're relying on. You're not relying on inflation, interest rates. You're not relying on any of that. You're relying on a specific thing in a specific location. This is what property developers do. They go in, they're looking for a spot for a particular reason that they can get their capital growth on their property development. Mistake number 5, buying a fully depreciated property. That's like buying a doghouse. A lot of times on, say, realestate.com, all the numbers stack up. Oh, look at the location. It's the worst property on the best street. And look how cheap it is. And all the numbers really stack up. It's not a passive property investment. That is an active property investment because you have to do a full refurb on it. And you have no idea how much money that's going to cost. And if you don't do the full refurb, you become a slumlord. And then you have no idea how much repairs and maintenance is going to be year after year. And it's just going to get worse and worse because the tenants you get are going to get worse and worse. And you're going to be constantly pulling cash money out of your pocket and putting into that property. The bank's not going to lend you more money for repairs and maintenance. Number 6, overpaying for a property. It's just a classic mistake that people suffer from when they get the disease called fear of missing out, FOMO. And it is a disease, and it's an emotional purchase of a property. We're capitalists. We have no emotions. We look at our equity, our cash flow, and we buy the property when we win, when we know we're winning. We don't worry about, and if we miss out, who cares? It's only a piece of property. Let a few deals go past, and then you'll know better what's a really good deal. You don't need to buy everything and anything. You're better off having a lot of deal flow and things going past. So never get sucked into overpaying for the property, and you usually get the best deal when you lowball and walk away. That's when you usually get the best deal. Number 7, just relying on realestate.com or domain for sourcing your property, all the real estate websites. Property hobbyists do that, not us capitalists, passive property investors. We don't sit there and scroll realestate.com all day long looking for this, talking to real estate agents whose only interest is to say whatever you want to hear to get you to buy that property so they get paid that fee from the person that they're working for. They're not working for you. And yeah, it's kind of like the lamb going into the wolf's den in a way. They're just going to chew you up no matter what. I mean, it is a resource to use, but don't spend all your day relying on that. You have to get other avenues for getting your properties. Number 8, listening to family and friends who are not investors and know nothing about real estate other than they bought one property themselves. Don't listen to them. Hear what they say, be respectful, be nice, but then you need to build your own professional team around you. And that team consists of an accountant, a lawyer, investment specialist. You could depreciation accountant, a research specialist, research analyst. They're out there. They're there. And you can use them, and you have to study and educate yourself on property. Don't rely. What you're doing is this. You're scared about buying the property, and you don't know who to trust. So you're transferring this trust from your family over into this investment space, and you're using their trust for the investment. That's not the trust you want. You want to have trusted property advisors. That's what you want. You have to go out there and find the ones you can give your trust to. Number 9, succumbing to FOMO in a high market. If the market's going up, people think, oh, I'm going to miss out. I've got to hurry up and buy. And they dive into that market, and then they get bad negotiating terms, or they borrow too much, or maybe they pay too much, or they don't work out their financials beforehand. They just rush in and buy it because they're afraid of missing out in a marketplace. We are passive property investors. We know our assets and liabilities all the time. This is an entrepreneurial business for us, so we know we're situated at all times. We never get fear of missing out, but when we see something we like, we make concerted action and we grab it. But we're not chasing the market when this market hype comes out in the media and they're talking about, boom. When is it not boom? We're not buying into a boom. We don't do that. Number 10, not fully maximizing tax advantage. This is just something I see all the time. I do help investors build their portfolios, and often they come in and they've got a property. I'm going like, well, you haven't done a depreciation schedule. It's like, you're not writing the depreciation off your tax. You know how much money that is? You can get like $5,000, $8,000 a year out of the government back to cash flow for you. And it's amazing how many people don't do that. It might cost you like $400, $500 for the depreciation schedule. You need that, and you want to have as much of that as possible. Yeah, another area where it's like when you sell the property, after you've done it for 12 months, you get a 50% tax cut on the tax that you pay to the government. This is a huge advantage that you get as a property investor, that you get to write the value of the property off at the same time, but then you get to get a 50% deduction on your capital gains when you sell it. And a lot of people don't realize that a lot of the reason that this helping us become these investors is this tax advantage we get. So you get to write off everything, the interest, the any expenses you have on the house. You can take the rental income and put it into your home loan, and then on an offset account, and then you get to reduce the amount of your home loan, which saves you tax on the money that you pay towards your home loan. And not having the proper tax strategy is just where people are just chipping away and not making as much on their property as they should. Okay, so that was my top 10 biggest mistakes that I see investors make, and I'm helping investors make their investment property purchases all the time, and this is what I'm seeing that people do, and I'm happy to share that with you so you can maybe avoid those mistakes. But yeah, that's top 10. Thanks for tuning in to The Passive Property Investor. If you enjoyed this episode, the best way to show your support is give a 5-star review on Apple Podcasts and Spotify. Make sure you subscribe to the YouTube so you don't miss a single episode. We're on all social media platforms, so feel free to connect with me there. And if you're having specific problems making your first investment or building your portfolio, maybe you don't know which location to invest in, how much you should invest, you're worried about who to trust, reach out for me down below. I will have the answers for you. Don't hesitate. See you on the next episode.